Warren Buffett, often referred to as the Oracle of Omaha, is one of the most successful investors of all time. His investment philosophy has not only made him a billionaire, but has also inspired countless individuals to approach investing with a more disciplined and thoughtful mindset. One of his most famous adages is, Rule number 1, never lose money. Rule number 2, never forget rule number 1. This seemingly simple principle encapsulates the essence of Buffett's investment strategy. It emphasizes the importance of capital preservation and the need to approach investments with caution and thorough analysis. Understanding this rule is crucial for anyone looking to navigate the often tumultuous waters of investing. At the heart of Buffett's investment rule is the concept of capital preservation. Losing money can have a compounding effect on an investor's wealth. When an investment loses value, not only does the initial capital decrease, but the potential for future gains diminishes as well. This is because recovering from a loss requires a higher percentage gain than the loss itself. For instance, if an investment declines by 50%, it must subsequently increase by 100% just to break even. Therefore, protecting one's capital is paramount. Buffett emphasizes that a successful investor must prioritize safeguarding their investments over chasing high returns. This principle encourages a more conservative approach, focusing on stable and reliable investments rather than speculative ventures that could lead to significant losses. To adhere to the rule of never losing money, thorough analysis of potential investments is essential. Buffett is known for his meticulous research and due diligence before making any investment decision. He advocates for understanding the business model, the competitive landscape, and the financial health of a company. This level of scrutiny helps investors identify potential risks and rewards. By investing in companies with strong fundamentals, solid management, and a competitive advantage, investors can minimize the likelihood of losses. Buffett often emphasizes the importance of investing in what you know, suggesting that familiarity with an industry or company can provide a crucial edge in making informed decisions. This approach not only aligns with his investment rule, but also fosters confidence in the investor's choices. Patience is another vital component of Buffett's investment philosophy. He believes that successful investing is not about quick wins, but rather about long-term growth. This perspective aligns perfectly with the principle of never losing money. By holding investments for extended periods, investors can ride out market fluctuations and benefit from the compounding effect of returns. Buffett's investment strategy often involves buying undervalued stocks and holding them until their true value is recognized by the market. This requires a steadfast commitment to one's investment choices and the discipline to avoid panic selling during market downturns. The ability to remain patient and not succumb to emotional decision-making is crucial for adhering to the rule of capital preservation. Another aspect of Buffett's investment philosophy is the debate between diversification and concentration. While many financial advisors advocate for diversification to spread risk, Buffett believes that a concentrated portfolio of well-researched investments can be more effective. He argues that diversifying too much can dilute potential returns and lead to mediocre performance. Instead, he suggests that investors should focus on a select few companies they truly understand and believe in. This concentrated approach allows for a deeper understanding of each investment, aligning with the goal of minimizing losses. However, it also requires a higher level of confidence in one's research and analysis. Investors must be willing to accept that while concentration can lead to higher returns, it also comes with increased risk if one of those investments underperforms. Acknowledging and learning from mistakes is a critical part of Warren Buffett's investment journey. He often reflects on his past missteps, emphasizing that every investor will face losses at some point. The key is to learn from these experiences rather than letting them deter future investment decisions. Buffett's willingness to analyze his failures provides valuable lessons for others. He encourages investors to maintain a growth mindset, viewing setbacks as opportunities for improvement. By understanding what went wrong and adjusting strategies accordingly, investors can better align themselves with the principle of never losing money. This iterative learning process not only enhances investment acumen, but also fosters resilience in the face of challenges. The psychological aspect of investing plays a significant role in adhering to Buffett's rule of never losing money. Emotions such as fear and greed can lead to impulsive decisions that jeopardize capital. Buffett emphasizes the importance of maintaining a rational mindset, especially during market volatility. Developing emotional discipline is crucial for investors to stick to their strategies and not react impulsively to market fluctuations. By cultivating a long-term perspective and focusing on the fundamentals of their investments, individuals can mitigate the impact of emotions on their decision-making. This psychological fortitude enables investors to remain committed to their principles, ultimately supporting the goal of capital preservation. One of the most powerful concepts in investing is compounding, which Buffett often highlights as a key driver of wealth accumulation. Compounding occurs when returns on an investment generate additional returns over time, creating a snowball effect. By adhering to the principle of never losing money, investors can maximize the benefits of compounding. When capital is preserved, it can continue to grow, leading to exponential increases in wealth. Buffett's investment strategy often involves identifying companies with strong growth potential, allowing for significant compounding over the long term. This reinforces the importance of patience and discipline, as the true power of compounding is realized over extended periods. Applying Buffett's investment rule in the real world involves a combination of research, patience, and emotional discipline. Investors can start by conducting thorough analyses of potential investments, focusing on companies with strong fundamentals and competitive advantages. It's essential to create a well-defined investment strategy that emphasizes capital preservation while allowing for growth opportunities. By setting clear criteria for buying and selling investments, individuals can avoid impulsive decisions driven by market noise. Additionally, maintaining a long-term perspective and resisting the urge to react to short-term market fluctuations can significantly enhance the likelihood of adhering to Buffett's rule. Warren Buffett's investment rule of never losing money serves as a guiding principle for investors seeking long-term success. By prioritizing capital preservation, conducting thorough analyses, exercising patience, and maintaining emotional discipline, individuals can navigate the complexities of investing with greater confidence. Embracing this philosophy encourages a more thoughtful and strategic approach, ultimately leading to more informed investment decisions. While the journey may be fraught with challenges, adhering to Buffett's principles can help investors build a solid foundation for wealth accumulation and financial security. As the investment landscape continues to evolve, the timeless wisdom of Buffett's rule remains a beacon for those looking to achieve lasting success in their financial endeavors.